Schrodinger's portfolio. Is your portfolio a winner until you look? Have you ever wondered if your investment portfolio is thriving or floundering when you're not looking? Imagine this. You invest in a stock and refrain from checking its performance for an entire year. Is it up? Down? Or perhaps in a state of uncertainty until you decide to take a peek. In 1935, Austrian physicist Erwin Schrödinger proposed a now famous thought experiment to illustrate the strange concept of quantum superposition. A cat is placed in a sealed box alongside a mechanism triggered by a radioactive atom. There's a 50% chance the atom decays and releases poison, killing the cat, and a 50% chance nothing happens, and the cat survives. But until someone opens the box to observe the outcome, the cat is considered both dead and alive at the same time, existing in a state of probability rather than certainty. Similarly, your investment portfolio exists in a superposition of gains and losses until you check its status. Each time you log into your account or refresh your investment app, you collapse this wave of possibilities into a definite outcome, be it a gain or a loss. Research in behavioral finance indicates that frequent monitoring of investments can lead to poorer outcomes. This phenomenon, known as myopic loss aversion, suggests that short-term focus on losses can drive irrational decisions, such as panic selling during market dips or overconfident buying during highs. The act of constant observation doesn't alter the actual value of your investments, but significantly impacts your emotional responses and decision-making processes. Seeing red might tempt you to sell prematurely, while green could lead to overzealous investments. In both cases, reactions are driven by immediate observations rather than long-term strategies. Perhaps the secret to better investing isn't about mastering the market. It's about mastering ourselves, resisting the urge to check, trusting the long-term process, leaving the box closed. So, how can you navigate this psychological trap and become a more disciplined investor? Here are 3 strategies. Limit portfolio checks. Reduce the frequency of monitoring your investments. Whether it's monthly, quarterly, or annually, find a rhythm that minimizes emotional reactions. Automate your strategy. Implement tools like dollar-cost averaging and set up automatic contributions to adhere to your investment plan without the need for constant oversight. Embrace uncertainty. Acknowledge that market fluctuations are natural. Accepting this can help you stay committed to your long-term investment goals without being swayed by short-term volatility. By adopting these approaches, you can cultivate a more resilient investment mindset. Remember, sometimes the best action is inaction. Trust in your strategy, resist the urge to constantly check, and allow your portfolio the space to grow. The next time your finger hovers over that refresh button, ask yourself, is this observation going to help me or hurt me? Can I live with the unknown just a little longer? And if you can, you might just become a better investor. Before you go, I'd love to hear your thoughts. How often do you check your investments, and have you noticed any impact on your decision-making? Share your experiences in the comments below. Don't forget to like, subscribe, and hit the notification bell for more insights on mindful investing. Until next time, invest wisely.